Dobar dan. That means a good day. What a crowd, what a crowd. I'm all right now, but last week I was in rough shape, you know. Anyways, sorry for all that, but the market's down a little bit. This is TalkCast PDX on the web, talkcastpdx.com. It's Tuesday, September 21st. Name of the show is the Bogdanich Perspective. I'm your host, Paul Bogdanich, and welcome. Title of today's show, I'm going to call it Forced, F-O-R-C-E-D, question mark. Question mark's important. I'm going to start with a graphic. I put this one up last week. If we could please put up number one here. We're talking about the markets and why the markets went down a little bit. And let's see, where's my graph, Justin? There it is. Okay, we put this one up last week, and it's just the S&P 500. That's the black line, daily closing prices of the S&P. And this graph goes from January 2nd, 2018, all the way to the end of this year. The big drop in the middle is the pandemic in between February and March of 2020. And what I was going to draw your attention to again is the character of the graph on the right side after the pandemic, and notice how it's been going up in a channel. Okay, the market's been moving up in a channel. The channel is angled such that it provides about a 30%. You can pull the graph down, by the way. Angled such that it provides about a 30% per year return. And we've just been going up in that channel, and everything's linear. On that graph, I did not have the activity of yesterday, but that graph was good until Friday. If you could put up number two, please. All right, this next graph, whenever it comes up for you, is just the very right edge of that graph. It goes from March 31st of 2021 to September 20th of 2021. And on the extreme right-hand side, you can see where the S&P line breaks the green line. It's listed on the graph, but 2 weeks ago on Thursday, September 2nd, that was the all-time high, the last all-time high, 4,537 points. And then I drew a little arrow to September 10th, which was not last Friday, but the Friday before that. Last Friday is where the graph intersected the little green line, where it crossed the green line. That was last Friday. And then the portion below the green line was yesterday. Okay. What's important to note is where it finished. It finished above the 100-day moving average, but it didn't do that intraday. If you could take that down and put up the next one, please. The intraday activity on this is important. Okay, what we should be looking at here on this graph is the activity during the day. Okay, the little dotted line is where the market closed on Friday, last Friday, which would have been the 17th. And then it opened below that, and then it went down, 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 and it hit a low. You can see right before it went back up in the last hour of trading, last 50 minutes roughly of trading, but it hit a low right before they took it back up. And that low was a 5.09% drop from the all-time high that it reached on September 2nd. Is that correct? Yes, September 2nd was the last all-time high. Okay. What that represents is there's a division of the New York Fed, the Federal Reserve Bank of New York, and they have a bunch of guys in there, and they're euphemistically known in the business as the plunge protection team. And when the market goes down, you can take that graph off, by the way, and when the market goes down, they step in. It's the Fed's mechanism. And as you can see, the market opened lower, and then it went down, 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 broke the 5% level, so a 5% correction from the last all-time high. And then they took it back up almost to where it opened. Now it's true, it opened quite a bit below where the Friday's close was. So the market overall shows down. Like if you read the Wall Street Journal and this and that, it'll omit that part. But they started to buy stocks in the market on Monday to recover the loss once it broke the 5% down level. They want to keep the market going up in the channel, increasing the wealth of more well-to-do and retired Americans is very important to the economy. It's one of the few things that are working right now. And this is what I say forced. For them to substantially come out of that channel that we put up on the two graphs, they're going to have to be forced. They don't want to. It's, the way they've been doing this for so long now that the economy has a lot of people relying on this increased asset value. And so they don't want to. So what's forcing them? It went down 5%. They weren't the ones selling. They came in and bought at the end of the day. So it was obviously pressure. So what's forcing them? Talking to a guy before I started the show, and he was reading the Wall Street Journal, and he got the impression that it was the Chinese and this Evergrande real estate concern. No. When Paramount leader Xi tells you repeatedly that houses are for living and not speculating, and he's done so for a year, and people continue to speculate, he's going to crush them like ants. They have more than enough money to cover this. It's relatively small by any standard. Our bank bailout was 12 times the size, even at its maximum estimate. And if they cover it all like that, they'll prosecute the executives, probably execute a few of them, so that people get punished. And they'll own all the property, won't they? The state. And then they can put people in it who can afford it. And so that's not it. We love blaming the Chinese, by the way, and the Russians, and just, it's never our fault, right? But in my particular view, what is forcing the market down? 3 things. The first one is government incompetence. We've been electing the same Congress people and senators for 40 years. They've been dealing with each other so long that they fight like an old married couple. They cut the entire bottom end off of all their payments cold turkey. They can't seem to come up with a debt ceiling deal. They can't seem to come up with a budget. They can't seem to do anything on tax policy. They can't seem to do anything on a stimulus bill. They can't manage the border. They're incapable of governing, essentially. They can't do it. And it's our fault, for reelecting them. But, that's the main thing that's bugging the markets, is these people are absolutely incapable. And irrespective of what they want to do or say they're going to do, they can't do it. All right. And that's what's driving the market down. That's the main thing. Second thing, from the Fed's point of view, is inflation. By pursuing this policy of increasing asset prices and increasing the wealth of people who hold assets, older, retired, wealthier, and they still, like I said, it's the part of the economy that's working, but they've been doing it for years. But in doing that, they're stoking inflation at the bottom end. Last week when I spoke, so exactly a week ago, on that day, the Consumer Price Index, which is referred to as the CPI, came out. And the Friday before that, the PPI came out. We compared them and we contrasted them last month, and we're going to do it again now. But as I mentioned last week, there's a thing called the COLA, which is the cost of living allowance. And that's the amount by which federal payments to individuals, federal retirement, Social Security, disability, every payment by the federal government to individuals gets increased by the COLA, the cost of living allowance. And when they set up the COLA back in 1982 or 3, they tied it to the CPI, the Consumer Price Index. So if the Consumer Price Index went up, that was the amount of inflation. And then once a year, they do a COLA adjustment and they increase the amount of benefits. And ever since then, they've had a systemic interest in understating inflation in the CPI because it's tied by law to the COLA. And so they do. They use all kinds of tricks and they change the way they calculate and they do all this stuff to keep the CPI underrepresenting inflation. But the PPI, which is the Producer Price Index, is a fairly straight number. Different categories, obviously. Producers use a lot of things that consumers don't, machine tools, raw aluminum, et cetera, et cetera. But if you go through the reports line item by line item, there's certain line items that correlate exactly in between the two reports. I did a convenience sample. If you could put up number 4, please, graph number 4. And these are just comparisons in between inflation as reported by the Producer Price Index, or the PPI, and the Consumer Price Index, or the CPI. And there you go. Second line down, beef and veal. 14.7% increase according to the PPI, and only 1.7% according to the Consumer Price Index. Pork, same thing. Chicken, same thing. Fish and shellfish, the reverse. Where you see a number that's got parentheses around it and in red, that means it's a negative and that the price has dropped. So according to the reports, fish and shellfish for producers was up 1.2%, but down 0.2% for consumers. Eggs, the reverse. Fresh fruits and vegetables, big difference. On the left-hand side, those are all food items. On the right-hand side, non-food items. Gasoline, pipe natural gas, like you pay the gas company for. Passenger cars, apparel. Shelter is a bit of a mangled statistic. It appears, you can take that down, by the way. It appears in the CPI, but there's no exact corollary for it in the PPI. So to get a PPI number, I went to Zillow and rent.com and all those places, and I took a low estimate. And they're saying that shelter, the CPI went up 0.3% in August. And these are only for a month, by the way. But all those sites say about 1%. And then I put in alcoholic beverages because that's near and dear to my heart. I'm very sensitive to inflation in alcoholic beverages. So I keep a very close track of that. So that's two things that are forcing the Fed to come out of the channel. The third, and I hate to harp on it, I really do. I know it's boring, but it's material. The COVID wave, that's happening. If you could put up graph number 5, and I'm going to be very brief on this. Graph number 5, if you can do that, please. Okay, the black line is just deaths per week. The green line is excess deaths. And you can see we had 3 prior waves, one that peaked April 18th, 2020, one that peaked August 1st, 2020, one that peaked January 9th, 2021. And over on the extreme right-hand side, the red dots are preliminary numbers. It takes this report about a month before they get the numbers straight. The dots with the black lines on them, those end on August 21st. But as of August 21st, deaths are back up to 1,550 a day. And it just depends how high that goes. Vaccination rates are high, et cetera, et cetera. You can take that down. But it's a force. It causes political problems, causes monetary problems, causes decrease in economic activity in terms of going out to restaurant shows, more so in some states than in others, but it's a force that is a drag on the Fed keeping the asset returns in the channel. I mentioned last week about the pandemic and that in my opinion, they have made the political decision on what to do with it, and that from this point forward, they would try and make the data and the reporting match the political decision rather than have the political decision being driven by the data. I think that's true. I'm going to mention 2 data points. The CDC, under the command of Dr. Fauci, changed the definition of what a vaccine is. The old definition, and this is off the CDC website, the old definition, a product that stimulates a person's immune system to produce immunity to a specific disease, protecting the person from that disease, unquote. That's the old definition of what a vaccine is. The new definition, a preparation that is used to stimulate the body's immune response against diseases, unquote. Please notice that they took out the part about immunity to a specific disease. Vaccines, under the new definition, do not provide immunity to disease, like the historical term did. A slang, an old slang, for a British person is a limey. The reason that they got that slang is they used to, in the 17th and 18th centuries, do a lot of very long overseas voyages. And they noticed that towards the end of the voyage, they were getting scurvy. And then they noticed that if you eat limes on the voyage, that you don't get scurvy. So they started taking limes on their voyages, and they were referred to as limeys. And we now know that it's not the lime per se, it's the vitamin C contained within the lime. And we make vitamin C supplements. So we take the vitamin C and we put it in pills, right? Under this new definition, a preparation that is used to stimulate the body's immune response against disease. A vitamin C tablet is a preparation that stimulates a person's immune system. It stimulates the body's immune response against a disease, scurvy. It's a vaccine. So when you take your vitamin C pill from now on, you're taking a vaccine under the change in the definitions. More importantly, the CDC, under Dr. Fauci, changed the way they count. This guidance is about a week and a half old. A breakthrough case is where you have somebody that's fully vaccinated that still gets the infection. Breakthrough cases in the United States shall only be counted if they meet all of the following. Number one, the patient has received the second dose of the Pfizer-Moderna shot at least 14 days prior. Number two, the patient tests positive for SARS-CoV-2. Number three, the patient is admitted to hospital for COVID-19 and or dies in hospital. End of guidance. If you're a fully vaccinated person and you get reinfected, but you're not sick enough to be admitted to hospital or to die in hospital, you're not counted. If you get sick such that you don't even go in and get a test, you're not counted. And so on. Anyway, they've taken steps to decrease the reported number of breakthrough cases by changing how they count. And that's all I'm going to say about that. It's a downward force. So you have the politics, you have inflation, and then uncertain economic activity born of a rise in COVID cases. Okay. And that's what's driving the market down. It's not the Chinese. All right. Talk about the markets. As I already showed, they went down from September 2nd. They fell for a week. They fell again the next week, a little bit, not much. And then went down quite a bit yesterday, but by the end of the day, they had recovered most of what they went down during the day, thanks to the Fed action. Today, they're fighting with about even, but the economic pressures still apply. We have 4 portfolios that we use to track this. 2 of them are just the top 30 stocks. One is cap weighted, the other is equal weighted. Then we have a portfolio that's got all 11 sectors of the S&P in it, top 3 stocks per sector. And then one that's discretionary that started out with 24 stocks that I manage, and that's what I want to talk about. I've been saying for weeks that my portfolio is fully hedged, and it is. The way that I used to do that is if you buy a stock, if it goes up to a point where the gain is good for you, how much money do I need this year? there's a lot of market sayings, and one of the oldest ones is, fair. What's fair? Fair is where they take the pigs to get slaughtered during the summer, right? Okay, that's the market definition of fair. So, but if it hits a return level that I'm comfortable with, then I write a covered call against it. Covered call is where they sell somebody the right to buy the stock at a reduced price, but they pay me the difference in between what it's trading for and what I sell the right for today. If I have a stock that's trading at 100 and I sell a right to buy it from me at 50 at a future date, they'll usually pay me $51, 50 for the difference in between the current trading price and what they're going to give me, plus $1 premium just for doing it. And I write covered calls against these investments. And the effect is it locks you out of participation on the upside if the stock goes up, but it protects you from the downside. And this last week I had Thermo Fisher, which is a stock that I bought on April 9th. It got called away. I sold the 480 calls on Friday of last week, September 17th. It was trading at it went up to $596.80. I sold the calls when it was trading at $538. I sold the 480s, so they took them from me. I got called away. It was up on Friday 8%, I think, $40. They're a medical company, but a device and supplies company, much like Becton Dixon or somebody like that. And they got a big contract for one of their testing kits, and their stock rose 8% on Friday the 17th. And it got called away. When I did the call on it, I sold the 480s and I got $60.45 for selling the calls. I refreshed the calls in between the time I originally sold them, and I added another $52. We'll talk about that. So I sold the 10 shares for a total of $5,457. On April 9th, I bought them for $486.11, which is $4,861 for the 10 shares. So I made 12.25%. The stock got called away for me, but I made 12.25%. If I would have just bought it like I did on April 9th and held it until Friday the 17th and then sold it while the stock was up 8% on the day because of the new contract, I would have made 22.78%. But because I had it fully hedged, I only made 13, 12.25. But what are my goals? How much risk do I want to tolerate? And 12.25 on a stock for whatever it's been, 5 months, I'll take that. When I went through the portfolios, I also sold the Verizon, the JPM, and the Honeywell. Made a little money, 1%, 2%, 3%. So they're not doing anything for me. They go up, they go down, they go up, they go down, and they're just not doing anything. So I sold them. I'd rather have the cash. I started with 24 stocks in the portfolio. I'm down to 13. What I sell? I sold Broadcom, and this is over time. Broadcom, Google, Home Depot, Honeywell, JP Morgan, Lowe's, Procter & Gamble, and Verizon. I got called out of Thermo Fisher, as I mentioned, and then previous few weeks ago, I got called out of SPGI, which is S&P Global, an information company. If these stocks corrected materially, I would repurchase S&P Global, symbol SPGI, or Thermo Fisher, symbol TMO. The rest of them, no. But I'm down to 13. And let's talk a little bit about the way the calls work. I have a list. I'm going to put it up in a minute. But for right now, let me just read off of it. There's one here, Lynn Corporation. It's it's an energy company, but they do pipeline and oil service. It's not so much, or Kinder Morgan, same thing, energy. I'll use Kinder Morgan as an example. Kinder Morgan, energy services, but they're mostly a pipeline company. They're not a driller or a producer per se. They're a pipeline company. And I bought the stock on April 9th, and then I wrote a call option against it. The current call option that I'm holding, I wrote the call option on September 10th. You can put up number 6, if you would, please. And you can look at this on the graph. I purchased the option on November 10th when the stock was trading at $15.97 a share. I purchased 25 contracts, which represents 250 shares. They don't expire until January 21st of 2022. The strike price, in other words, what they can purchase the stock from me for, is $10 for a stock trading at 16, right? The premium, what I got for selling them, and they were trading $15.97 at the time. I got $6.05 on top of the $10, so I got $16.05. See where it says priors? A prior is where I had a prior call option on it, but I sold the call option and bought a new one. I sold the old one, bought a new one, and I could do this in this stock today. I sold these contracts at $6.05. Yesterday they were trading for $5.60. So I could repurchase the ones that I sold here, make that difference. That would go into the priors column, right? And then repurchase a new option just to keep myself covered. And that's how you build up a surplus in the priors. But when you add it all together on all these stocks, the two most right-hand columns are what's important. The very column to the right is what I would be at if I just bought the stock on April 9th and held it to yesterday. And the column to the left of that is where I am with my hedges. And, you can freeze the video here and look at it. But, I don't know. What's a good example? The best one is Kinder Morgan. I've traded it so many times that I have almost $900 in priors, $900 in priors. I'm currently nursing an 18.8% gain. And if I'd have just bought it and held it, I'd be down 5.1%. On the downside of that equation, look at Microsoft. I'm with my hedges and everything, I'm only up 6%. If I'd have just bought it and held it, I'd be up 15%, and so on. The whatever it is, 11 stocks or 12 stocks on the top there are all covered with call options. On the bottom, CMCSA is Comcast, and I still own the shares, but I have a put option against it. I bought the $65 puts expiring in January of 2022, and I paid $7.55 a share. They're currently trading at $9.60 a share, so if I sell them, I make more. And Pfizer, I don't own any stock. I used to own the stock, but I sold it, but I kept the put because I think it's got problems going forward. And I sold $45 puts at $2 a share. As of yesterday, I was up about 96%. You can take that down if you will. And with that, let's go and look at our portfolios. We count Friday to Friday here. And last Friday, the markets for the week were only down 25.6 points. So the big action was yesterday, which we already covered. But that's 0.6%. So you would have expected to lose $575 on one of our portfolios. The top three cap weight lost 528. Close. The top 30 equal weight lost 757. So it lost more than the markets. Top three every sector lost 509. Little less, but in the ballpark. And my stocks lost 584, but my hedges returned 635. So I made a net $81. And this is last week. It doesn't include Monday, but we'll get to Monday next week. If I just look at the way my hedges performed, my biggest loser last week was Comcast. Should have subtracted $171 from the portfolio, but the hedges returned $130. Facebook should have subtracted $140, but the hedges returned $141. Apple should have returned $87, but the hedges returned $93, and so on. Exxon should have added $83 to the portfolio, but the hedges subtracted $60. Target should have added $43 to the portfolio, but the hedges subtracted $38. But last week I only had 5 stocks that went up, and 5 minus 13 is 7. The others went down, so I was better off with the hedges than without them. If we look at our other portfolios, top 30 equal weight had 2 losers above $100, Microsoft and Tesla. This is top 30 cap weight, excuse me. 2 losers above 100, or 2 gainers above 100, sorry, Microsoft and Tesla. So both those were up, and it had 2 losers below $100 for the portfolio. Facebook which lost 237, and Apple, which lost 282. As should come as no surprise, those Apple, Facebook, Microsoft, and Tesla are among the largest stocks. That's a function of the portfolio, top 30 stocks, cap weighted. If we go to the top 30 equal weight, where you don't purchase more the larger the company is, it had two stocks that went up, but those were United Healthcare and Tesla. Microsoft didn't make the list. And you had four stocks that went down more than $100, and those would be Comcast, NVIDIA, Facebook, and Nike. They're all still in the top 30 stocks, but, different names, obviously. If you go to the top three by sector, 11 sectors of the S&P, two stocks up, ConocoPhillips and United Healthcare. So an energy company and a health services concern. Three stocks that went down: Duke Energy, NextEra Energy, which are the two other energy companies. So with the exception of Conoco, the energy sector was down, and Facebook that dropped last week. And then my portfolio we already talked about, and the hedges we already talked about. If we take all 54 stocks and all four portfolios and look at them, there were four stocks that went up more than 2%. And those were Tesla, rising 3.2%, United Health rising 4%, Thermo Fisher, that stock that I got called out of, rising 4.3%, and ConocoPhillips rose 5.8%. I think they announced that they're selling their Permian assets to another company. You had two other stocks that went up more than 2% but less than 3%, and that would be Lowe's and ExxonMobil. Then you had five stocks that went up more than 1% but less than 2%, 8 stocks that were up but up less than 1%, and that's it. So 20 stocks were up and 34 were down. Of the 34 that were down, 10 were down but less than 1%. 12 were down more than 1% but less than 2%. 6 were down more than 2% but less than 3%. And 7 stocks lost more than 3%. And those were Southern Company, which is a utility energy company. Duke Energy, obviously an energy company. Pfizer lost 3.7%. Comcast lost 3.7%. NextEra Energy, another energy, that's a utility, solar in that case, lost 3.9%, and Nike lost 4.4%. And so the gains were the losses over last week and again yesterday were spread. It represented a diminution in the P to E ratio. In other words, you have a house that's worth $100,000 today, $200,000 a year from now. It just went back to 190. Same house, haven't done anything to it. It's just people are willing to pay a little less for it. In my view, the pressure still exists. I'm keeping my hedges on. If I was aggressive, I'd take them off for a week, capture the gains, and then put them back on. I'm not that aggressive, because I've been alive too long. The political problems are real. They're not the Chinese's fault. We're incapable. Our political system is incapable of providing benefit for the people or managing their own affairs. And I think it's a huge risk. The extended policy of driving up asset prices is starting to have a correlation to inflation. It's not a problem at this point, but if it goes higher, that's a material risk. And I'm uncomfortable, so I'm going to keep the hedges on and take my lumps. And that's it for today. It's Tuesday. Name of the show is the Bogdanich Perspective. Most reliable place to find it is TalkCast PDX on the web at talkcastpdx.com. If you have questions, comments, or emails, send them to me at paul@stockbetor. That's paul@stockbetor, BETTOR.com. And hopefully see you next Tuesday, see what we have to talk about, see what the market does. And thank you for joining. And do widzenia, which means goodbye.